Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Cole Harmonson of Far West Capital. Cole, thank you for joining us.
Hey, Hall. Thanks for having me. I appreciate it a lot.
Great. So can you talk a little bit about your background before you started working with early stage companies?
Yeah, so I've been in community and commercial banking my entire career. And I joined the dark side of entrepreneurship back in 2007 after a business that I was running for a bank sold to another bank, and I decided to jump on the other side of the street, if you will, and start a company that loans money to high growth, turnaround, and other companies that need bridge capital for basically for working capital purposes only.
So we have a lot of investors and others who work with early stage companies, financing and loaning and other such things. What's your advice to those people who want to start working with the early stage startups?
Yeah, so as far as what we do at Far West, in terms of if you're an investor in or an entrepreneur running a high growth business and you're trying to solve a working capital problem, in other words, your costs occur very quickly and your cash cycle occurs, let's call it 45, 60 days, you're going to have some issues in terms of growing. And what some of the mistakes that we've seen entrepreneurs make are they solve a working capital problem with equity. So from an entrepreneurial standpoint, the dilution gets pretty heavy and can be pretty onerous. And so what we counsel our clients to do and why people come to us is because they see an opportunity to take advantage of a specific marketplace. And they know, again, that there's going to be, they've looked at their cash flow and they can see we're going to have some issues here. And they come to us in order to solve that problem versus selling part of their business at the wrong time. From a valuation standpoint, the conversation is a lot different if you've reached some level of scale. And so we've seen people do this at an early stage. We've seen people do this after a turnaround or maybe a pivot in their business from that perspective. So people come to us mostly to avoid dilution. And we don't have to have profitability inside the business in order for us to lend into a situation that requires way more working capital than they can internally generate.
Great. That's good advice. So you've been working in this space for some time. How do you see the industry evolving and changing?
Well, I think in 96 or basically right before that, let's call it in the 80s, that just means I'm old, but there were literally guys flying out to the oil field in Texas with briefcases full of cash and buying invoices for, let's call it a 10% discount, which, as you know, annualized is a very, very high number. And so that was back then. And there was a handful of players since I got into the business in 96, but it's evolved into a very well-known asset class for banks across the United States, across the world for that matter, that have gotten into this line of work. So there's lots of money out there chasing yield, which means that you don't have a guy flying out to the oil field with briefcase full of cash. It's most major banks, many regional player banks are in this space and very aggressively seeking clientele in this world. As you know, we haven't had a recessionary event or a hint at a downturn in the last few years. And from that perspective, there have been not a lot of washouts. So you've seen hedge funds enter this business in a big way where people see that they can get yield. You have peer-to-peer platforms. You have publicly held entities getting into this business. You also have pressure from companies like AT&T or Xerox or large companies with lots of cash on their balance sheet offering to quick pay their vendors. So there's competition from every single angle. I think there's 850 quote unquote factoring companies in the United States and 23 million small businesses, but you also see pressure from companies like the on deck capitals of the world, a publicly held, what we would call an MCA lender, Cabbage, Yellowstone Capital, those type of small business lenders. We're in the trucking space. We have about 450 clients or so. And of that 450, maybe 200 or so are in the transportation business. And we're in El Paso, where I think 20% of the nation's exports come through El Paso. And we had a prospect tell us the other day, as they were in our office closing, which we were grateful for, that they had, and I don't know if this was an exaggeration or not, but 50 to 80 calls a day from various companies across the United States offering to finance their transportation invoices. So just to look back over the last 20 years, maybe even the last 5 years, it's become much, much more competitive in this space, and lots of money out there chasing yield.
Sounds like it's a hot space to be in. Everybody wants to get in. So for Far West, what's your specific thesis for it? What companies do you focus on or look for that fit your criteria?
That's a great question in terms of what our differentiator is. And I can give you an example of a company that came to us and why they would choose us over someone else, because there are lots of people out there to be able to finance accounts receivable, but they chose us. It was a very experienced management team and had also a private equity shop that had invested in this particular company. And let's just say the plans were not working out. They had fired the CEO and were promised all this growth, and it did not happen. And so actually one of the partners of the private equity firm stepped in and took over the business on a day-to-day, put some of his own capital in the business. There was a really strong turnaround plan executed, but they hadn't necessarily made a bunch of traction in terms of profitability in the business. And so they have customers that are names that you would recognize. And so the receivables are very, very clean, but they wouldn't necessarily get a bank deal or a bank from a bank pricing perspective. But they chose us because they knew that we could flex between a scenario like theirs where they're going to be doubling their business, going from $1 million, $2 million a month. So they're going to have a very strong need for working capital. They have a little bit of construction element to it, but they needed to be able to flex into, once they hit their numbers, which was, we call that about 6 months worth of turnaround of making money. They want to negotiate a much better deal. And instead of having to move banks, which is quite the process, and we're able to offer kind of a one-stop shop in terms of the type of product that we offer, which is on one side a factoring by one invoice, and on the other side of that is a line of credit, much more akin to bank rates and bank type covenants and those kind of things. So our thesis, the short story is, we want to focus in niche markets like construction, transportation, and places where it's a little more challenging you need to have a very nuanced understanding of the industries that you're in, especially for construction, and be in those worlds and do it really well. And then offer a range of products that others can't necessarily match if you haven't been in the space for as long as we've been in the space.
Yeah, that sounds like a good strategy. Go where others aren't and get an expertise in niches that others don't have, and then provide additional services that others don't. Do you have a couple of example companies that you funded and how it's a good fit for them?
Yeah, I think in one space on the construction side, we had a company that came to us that was getting kicked out of a very large bank because they didn't meet their numbers. They lost money on a big job. But this was a generational business, $150 million a year company in revenue. with substantial footprint and expertise in their market, and their bank basically just said, "Hey, you know what? You're not doing what we thought you would. You're out. We want you out." And so we went in, met with the team, flew them down here. They're out of state, and really dug in, got to know the team, got to understand what had happened with the business and what their thesis was for going forward, and why we could buy into that story. And so they actually pledged some additional collateral that previously had not been pledged to the other bank. And we struck $8.5 million credit facility for them. And they were able to execute on their plans, continue to grow their business, and not think about on a day-to-day basis how they're going to make their payroll and have working capital to execute their plans. We actually worked with the third party there as well, who we've developed a deep relationship with, to finance some of their bonded jobs, which previously were ineligible. So we don't do that specifically here because of our deep expertise and knowledge in terms of understanding the marketplace. We were able to put $1 million part of the facility available for them to be able to do something that no one else could do. So yeah, that's a great relationship, which as they've hit their numbers, we've renegotiated with them, released some of that additional collateral, and it's been a kumbaya story for us in that world. So that's I think a great example of kind of the capabilities and why someone would choose to come with us.
You talked about construction, and what are the other niche applications you think that are really good opportunities to pursue?
We're seeing a lot of activity in the lend into. There's not really any receivables related around the cannabis space right now, but certainly for the CBD space, we're seeing CBDs for animals and all kinds of use cases and applications for that type product. So we're actually signing a deal this week that is selling into Costco, CVS, some other big names, with a manufacturer, a publicly held company that is in that space. So I think anything in the sort of the CPG, consumer products, we have a green drink business, we have a kombucha live soda business, we've done an energy drink deal. So we see those sort of niche businesses, and those are the types I think that are really, really well suited to us, that could be complementary with equity as well. So you've got companies that we know are going to probably be losing money for a foreseeable future because of the nature of having to market a product like that very, very rapidly. And the valuations historically being based on a multiple of revenue. Not everyone is shooting to have a lifestyle sort of family generational business. It's more of, let's get into the marketplace. We've done some tequila. We've done those kind of applications where folks come to us and say, hey, we need working capital because we have to either pay our co-packer or we have to buy the raw materials to actually produce this. So the CPG space, especially here in Austin, has been super hot, and one where we're particularly well suited. For example, someone came to us when they were less than $1 million in revenue, and we presented this plan to them. And this goes under the header of mistakes in terms of how not to do it. But this was years ago. They came to us and they said, hey, we have this plan for this drink business, and we think we can grow it to X dollars. And we've raised a little bit of equity at this point, but we actually need money for raw materials and equipment and such, and we want to get rolling. And so we got up on the whiteboard, sort of scratched it out with them. Hey, if you let us finance the purchase of your inventory and your receivables until you get to $5 million a year, which would be like, according to your projections, maybe that's 2 years from now. Think about the difference between the conversation with an equity group at $1 million, or think at $5 million where you're almost cash flow break even, or maybe you're making a little bit of money. You control your destiny so much greater. And that person actually said, we're going to go ahead. They went ahead and took equity, and they did grow the business, and they got up to 15 or so million. And then they came back to us after their investor had basically put all that they were going to put into the business at that point, and they still needed working capital. And so at that point, the founder owned way less than 20% of the business, which we think could have been a much different scenario. And again, they ultimately sold, the company did well, but it's the difference between for a founder owning 20 or owning 80, just for simplicity's sake.
That's quite a different outcome there, and equity is pretty valuable. I find as the company gets bigger, the bigger it becomes, the more they realize how much equity is really worth. In the early stages, they seem to throw it on the table pretty quickly, but later years, they start to be more reticent to put equity on the table. So it's a good life lesson there for sure. So how best for listeners to get back in touch with you?
Well, we're on the Twitters at Far West Cap, and we are on the interweb at farwestcapital.com. That's probably the best two places to find us. LinkedIn profile, Cole Harmonson, but pretty easy to find.
Great. We'll add those into the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Awesome. Thanks, Paul. Appreciate it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.